Hey everyone, welcome back to Corporate Decoder, the place where we dig into the financial reports of companies. Today, we're cracking open LendingTree's latest report. You know, the kind of company you use to compare loans. Get ready for a bit of a roller coaster ride. It's got some surprising twists and turns. LendingTree just dropped their annual 10K report, which is basically a company's yearly homework assignment for investors. At first glance, things might seem a little bit complicated. But don't worry, we're going to translate all the confusing corporate jargon into plain English. First up, this section just lays the groundwork stating LendingTree's stock is indeed registered and traded on the Nasdaq under the ticker symbol TREE. It's like confirming that, yes, this is a real, publicly traded company. This tidbit tells us how much the company was worth midway through last year, around $457 million. It's a snapshot in time. It's important to remember that this number can change drastically in a short time depending on the company performance. This is our official trigger warning, forward-looking statements ahead. Basically, this means LendingTree will be making predictions about the future, and well, those aren't guaranteed to happen, so take everything with a grain of salt. Every company needs to explain what could go wrong. LendingTree's risk factors cover everything from economic downturns making it harder for people to get loans to data breaches. They also highlight their reliance on relationships with network partners, meaning the banks and lenders in their system. If those partnerships go south, LendingTree could feel the pinch. Here, LendingTree describes what they do, operate what we believe to be the leading online consumer platform. It's like a digital mall where you can compare loans, credit cards, and insurance offers. They make money by charging those network partners a fee whenever someone like you or I submits a request through the platform and gets matched with a potential lender. This section doesn't sugarcoat things. LendingTree acknowledges that high interest rates and inflation have been tough on their mortgage, consumer, and insurance partners. Specifically, they saw declines in mortgage activity because people aren't refinancing as much when rates are high. The insurance business also had its share of problems as companies tried to raise prices to offset the impact of inflation, persistent industry headwinds, supply chain issues, rising accident severity and frequency, and hurricane losses. LendingTree breaks down its business into three main categories or segments: home, consumer, and insurance. This helps investors see which parts of the company are doing well and which are struggling. Now for the numbers. Revenue increased from $672 million to $900 million. Digging in, we see that Progressive and Allstate, two huge insurance names, accounted for a significant chunk of LendingTree's revenue, 22% and 11% to be exact. This reveals a major reliance on just a couple of big players, which can be risky. LendingTree makes all of their filings available online. Investors can head to the SEC's website to view them. These are the things that could really hurt LendingTree's business. This includes adverse conditions in the mortgage market or the economy in general, as well as potential changes in their relationships with their network partners. They also note the importance of maintaining their reputation and attracting customers. Like pretty much every company these days, LendingTree depends heavily on technology. So any tech glitches, system interruptions, or security breaches are a major threat. They also admit that new AI tech might have deficiencies. This isn't exactly thrilling, but it's important. Because they're in the financial services and insurance industries, LendingTree has to follow a ton of rules and regulations. Failure to do so could mean fines or even losing their licenses. Data privacy is a huge deal, especially now. If LendingTree messes up how they handle your personal information, they could face lawsuits or government action. LendingTree warns that their stock price could be volatile. Many things can swing stock prices and cause investor perceptions to be adversely affected and potentially resulting in restatement of our consolidated financial statements for prior periods and a decline in the market price of our stock. Here's where things get a little more complicated. LendingTree has these things called convertible senior notes, which basically allow the holders of the notes to convert the debt into stock, but only under specific conditions. Depending on what LendingTree chooses to pay with, they may need to settle a portion or all of their conversion obligation through the payment of cash, which could adversely affect our liquidity. In terms of cybersecurity, it states the Chief Information Security Officer, CISO, is responsible for the assessment and management of cybersecurity risk, and that audit committee gets the updates as needed, but at least on a quarterly basis covering cybersecurity matters. They utilize the National Institute of Standards and Technology (NIST) framework, which organizes cybersecurity risks into 5 categories: identify, protect, detect, respond, and recover. Even with all of that, though, they can't guarantee they won't experience a breach. A quick note, LendingTree's main office is in Charlotte, North Carolina. This outlines some of the legal issues they are currently facing, specifically that QuoteWizard.com LLC is in a class action alleging violations of the Telephone Consumer Protection Act. This confirms LendingTree's stock is traded on the Nasdaq under the symbol TREE and that they don't plan on paying dividends anytime soon. The report's financial highlights include the number of shares outstanding, and the net loss per share is a loss of $3.14. This section details how each of LendingTree's segments performed. Segment profit is calculated as segment revenue less variable costs paid for advertising. Here we see the home segment taking a hit with revenue down 10%. The consumer segment is more of a mixed bag. Personal loans are up, but credit cards are down. The insurance segment was the clear winner, growing 120%. There are some tables about the company's marketing and revenue, but again, keep in mind that those can be volatile depending on the market and consumer performance. The overall adjusted EBITDA for the whole company sits at $104 million. LendingTree had $106.6 million in cash at the end of the year. Operating activities provided $62.2 million in cash. LendingTree has some credit facilities that they use to fund their business. A portion of the term loan was used to pay the outstanding balance and interest on their 0.625% convertible senior notes that matured. In March, they entered into a term loan which matures in 2031. The stock plan allows employees to benefit from company choices, as employees are stockholders of the company and take charge and have a direct impact on company choices. The company is exposed to market risks, primarily changes to interest rates. This says that the carrying amounts of LendingTree's financial instruments are equal to fair value, which is a very important point and shows good standing. Looking ahead, LendingTree is projecting to use cash on hand, available borrowings of $50.0 million from the 2024 term loan, and future cash flows from operations for the repayment of the 2025 notes. Now that we've decoded this complex report, let's zoom out and make sense of what it all means. LendingTree is definitely in a transitional phase. They navigated some tough economic conditions, particularly with high interest rates impacting their core mortgage business, and they've had to streamline operations with some workforce reductions. However, their insurance segment is a major bright spot, showing impressive growth. Their strength lies in their established brand and online platform, putting them in a good position to capitalize on the shift toward digital financial services. One of their biggest challenges is navigating regulatory compliance. With the heavy regulation of the lending and insurance industries, they always face the risk of running afoul of the rules. Also, the reliance on just a couple of network partners in the insurance segment creates a concentration risk. In conclusion, LendingTree appears to be cautiously optimistic. The performance of the insurance business in particular has been strong over the last period. The strength of their AI implementation and cybersecurity will determine the future of the company's success. The biggest risk they are looking at right now is the debt they are trying to pay off. Thanks for watching. If you found this video insightful, please like, subscribe, and let me know what company we should decode next in the comments below. Until next time, stay financially savvy.